The market is on a knife's edge. While everyone was watching Bitcoin, a reported $20 billion buy order for Ethereum from Tom Lee is shaking things up, sending ETH soaring. The modern investor points out this is causing a major supply crunch as companies load up. But is this the real alt season? Ben Cowen presents a historical pattern that suggests a September pullback is coming right before a final Q4 rally. Meanwhile, politics are heating up. Lark Davis breaks down how a Trump executive order could funnel trillions from 401ks into crypto. With so much happening, from Chainlink's real-world asset tokenization to fears over the next CPI report, are you positioned for the volatility? The signals are conflicting, and knowing what to watch could make all the difference. In the latest video from Altcoin Daily, Michael Saylor presents his case for why Bitcoin is on a path to $1 million. He argues that the environment for Bitcoin has completely changed. For starters, he points to a newly supportive White House, claiming there are now 12 pro-Bitcoin cabinet members, a significant shift from just a year ago. Saylor mentions a new 150-page crypto policy report from the administration that shows enthusiastic support, including plans to address unfair tax treatments for digital assets. Michael Saylor's optimism is infectious, and he builds a compelling argument based on institutional and governmental acceptance. His points about corporate treasury adoption and the supply shock from the halving are hard to ignore. It is true that major companies and even some governments are adding Bitcoin to their reserves. However, Saylor's view represents the peak of Bitcoin optimism. While the White House has shown a more receptive tone, the regulatory path in the U.S. is still being paved and isn't entirely straightforward, especially outside of Bitcoin. The idea that winter is not coming back might be premature. The crypto market is famously volatile, and while the new ETF demand provides a strong floor, it doesn't eliminate the possibility of major price corrections driven by macroeconomic factors or unforeseen events. The market has matured, but it's probably not immune to cycles just yet. In the latest video from the Crypto Rover channel, the host explains why Ethereum just shot past $4,400. He says it's not just about the latest economic data. A massive $20 billion buy order for Ethereum is reportedly on its way, orchestrated by Tom Lee. To put that number in perspective, he points out that Michael Saylor has only bought about $7.4 billion worth of Bitcoin, and we all saw what that did for its price. The host is holding his own long position on Ethereum, which is currently up over $600,000. He believes this is just the beginning and that Ethereum is outperforming Bitcoin, a classic sign of the later stages of a market cycle. His analysis suggests that if Ethereum can break a key resistance level against Bitcoin, we could see an even bigger rally. He's looking at a price target of around $6,400 for Ethereum and plans to start taking some profits when it hits the $5,000 mark. He also predicts that after Ethereum has its run, the next big move will come from altcoins, which he says have historically gone up by huge multiples in the final 2 months of the cycle. The excitement around a potential $20 billion influx into Ethereum is definitely a big story. It's true that Tom Lee and his firm, Fundstrat, are very positive about Ethereum, especially with the recent ETF approvals creating a clearer path for institutional money. However, it's worth noting that this kind of capital doesn't usually come in as a single giant market buy. It's more likely to be deployed strategically over time. The real story here isn't just one potential fund, but the broader trend of large-scale investors viewing Ethereum as a serious asset class. This shift in perception is what could provide sustained buying pressure for Ethereum rather than a single explosive event. The narrative is powerful, but the mechanics of how that money enters the market will probably be more gradual. In the latest video from Lark Davis, he talks about how a recent executive order from Donald Trump could completely change the game for crypto investing. The order aims to redefine 401k rules, potentially allowing alternative assets like cryptocurrencies to be included in retirement plans. This is a big deal because the U.S. 401k market holds about $12 trillion. While it won't happen overnight, as it requires studies from the SEC and Department of Labor, the direction is clear. Even a tiny 1% allocation from that $12 trillion would mean a $120 billion injection into the crypto market. He points out that this could lead to huge amounts of crypto being locked away for decades in these retirement funds, which would seriously reduce the available supply and could push prices up. He mentions a CoinGecko report that showed Bitcoin outperforming the S&P 500 and gold significantly over the last decade. The main message is that this is a long-term development, like a slow-starting engine, but one that could lead to an unstoppable wave of adoption and price appreciation for crypto. My take on this is that the financial implications Lark discusses are spot on, but the political maneuvering behind it is just as interesting. This move by Trump feels less like a detailed financial policy and more like a strategic play for the rapidly growing crypto voter base. By promising to open up 401ks to crypto, he positions himself as the pro-innovation, anti-establishment candidate, directly contrasting with the current administration's more regulatory-heavy stance. It's a powerful narrative that taps into the desire for financial freedom. However, it's important to remember that an executive order to study something is a long way from an implemented rule. The actual follow-through would depend on an election win and then navigating the massive bureaucracy of the SEC and the Department of Labor. It's a fantastic headline, but the path to seeing Bitcoin in your average 401k is still a long and politically charged one. In the latest video from the Ben Cowen channel, he breaks down a very specific historical pattern that has signaled the end of every Bitcoin bull market so far. He points out that in past post-halving years, 2013, 2017, and 2021, Bitcoin's price has consistently gone up in July and August, followed by a pullback in September. This September dip historically finds a bottom at the bull market support band, which is the 20-week simple moving average SMA. After that, Bitcoin enters its final rally in the last quarter of the year, Q4, to set a new market cycle top. Ben Cowen's methodical, data-first approach is always a refreshing change from the usual hype. The historical pattern he outlines is incredibly compelling because it's not a one-off event. It's happened 3 times with precision. It makes a strong case for watching September very closely. However, the big question this cycle is how the new spot ETFs will affect this historical rhythm. We're in uncharted territory with the level of institutional money flowing in. This capital could potentially soften the September pullback, or maybe even push the final Q4 rally beyond the limits of the diminishing returns theory he presented. His take on altcoins feels spot on with current market sentiment. It seems like the capital is staying concentrated in Bitcoin, and the narrative of a broad alt season just hasn't materialized the way many expected. It's shaping up to be a test between a well-established historical pattern and a brand new market structure. In the latest video from Coin Bureau, Guy argues that the biggest threat to humanity isn't what you think. It's the silent collapse of global populations. It turns out the old fears of a population bomb were wrong. The new crisis is that we're running out of people, and it's happening faster than anyone predicted. The video shows that the new global population peak is expected to be around 9.7 billion by the 2060s, a much lower and sooner peak than previously thought. Countries like Japan have been shrinking for years, and South Korea's birth rate is a shockingly low 0.72 births per woman, far below the 2.1 needed to maintain a population. My take is that this video nails a topic that's often pushed to the side in favor of more immediate crises. The idea of a demographic shockwave isn't just a future problem. We're seeing the tremors right now. Look at the recent waves of unionization and strikes across the US and Europe. That's a direct symptom of labor realizing it has leverage it hasn't had in decades. The video's point about Japan is spot on, but it's not just an isolated case anymore. What's particularly interesting is the tension this creates. On one hand, rising wages for workers is a good thing for inequality. On the other, it's a huge driver of the stubborn inflation central banks are fighting. It feels like we're caught between an economic model that needs cheap labor to keep prices down and a new reality where labor is no longer cheap. This demographic shift is the slow-moving, unstoppable force that will likely define the next few decades of economic policy and social change. In the latest video from Crypto's Russ, the host breaks down why the crypto market took a sudden downturn. He suggests it's mostly due to Wall Street's jitters about tomorrow's big CPI inflation report. The fear is that if inflation comes in higher than the expected 2.7 to 2.8%, say around 2.9% or 3%, it could send markets tumbling. On the flip side, if the numbers are lower than expected, it might even open the door for a 50 basis point interest rate cut. Interestingly, he notes that sometimes bad inflation news can actually be good for Bitcoin. as people turn to it as a hedge. The speaker's take on Ethereum leading the charge feels very accurate right now. The recent approval of spot Ether ETFs in the US has clearly been a major catalyst, validating his point about massive institutional interest moving into ETH. This isn't just speculation anymore. It's a structural shift in how large-scale investors view the asset. The ETH to Bitcoin performance chart confirms this trend. However, his caution about this being the very beginning of an altcoin season also rings true. While Ethereum is getting a lot of attention, many other altcoins are still lagging significantly. The market seems to be following a classic pattern where capital flows from Bitcoin into Ethereum first, before potentially spreading to the wider altcoin market later. We're watching that transition happen in real time. In the latest video from Crypto Wendy, she explains why she's a big believer in Chainlink, a project she thinks ties both traditional and decentralized finance together. She describes how Chainlink's oracles are essential for providing accurate price data for DeFi, making everything from cross-border payments to other financial apps work correctly. A major point she brings up is Chainlink's role in tokenizing real-world assets, RWAs, which lets big companies like BlackRock put things like stocks and real estate on the blockchain. It's interesting to see the focus on the ICE partnership as it's part of a much bigger picture for Chainlink. This isn't just about one company using their tech. It's about a consistent strategy to become the standard for connecting real-world data to blockchains. For example, their ongoing work with SWIFT, the global financial messaging network, points to the same goal. They're trying to build the essential plumbing that will allow the entire global financial system to interact with tokenized assets. While the crypto market often gets distracted by short-term trends, Chainlink is quietly building a foundation that could be indispensable in the future, making itself a bridge between two worlds rather than just another crypto project. In the latest video from The Modern Investor, the host talks about a digital tug-of-war in the crypto space. He starts with Ethereum, which is making a big comeback. Big names like Mike Novogratz are saying ETH could outpace Bitcoin soon because so many companies are now buying it up for their balance sheets. This is creating a major supply crunch. One company, Bitmine Immersion Technologies, now holds about $1.12 billion in Ether. This corporate buying spree has revived talk of the flippening where ETH might overtake Bitcoin. The video then shifts to the SEC, which has once again delayed a decision, this time on Grayscale's Solana Trust ETF, pushing it to October. The host believes these repeated delays aren't about regulation, but are a tactic to give wealthy investors more time to load up before a wave of ETF approvals expected in the fall. Finally, he covers the growing trend of altcoins getting their own treasury companies. The Ton Foundation is setting up a Toncoin treasury and plans to raise $400 million. This follows similar moves for coins like Litecoin and Solana, showing that big money is spreading its bets across many different crypto projects. The video does a good job of connecting the dots between what look like separate news items. This trend of corporations creating treasuries for specific altcoins like Toncoin and Litecoin is telling. It suggests a strategic shift beyond just holding Bitcoin as a store of value. Companies are now betting on entire ecosystems. They're not just buying a coin. They're investing in the network's potential for smart contracts, apps, or in Toncoin's case, its integration with Telegram's massive user base. This is a much more involved form of adoption than we saw a few years ago. The skepticism toward the SEC's motives also seems justified. The timing of these delays consistently lines up with periods of accumulation, which makes the official reasoning feel less credible to many people in the space. It really does feel like a calculated effort by institutional players to position themselves before the market opens up to the masses through ETFs.